Well, hey there, everyone. Happy Thursday, January 15th, and welcome to Chart This with Dave Keller. I'm your host, Dave Keller, coming to you from a kind of beautiful January day here in Redmond, Washington, talking to family in Cleveland, family in northern Michigan today. Lots of snow coming down, blizzard conditions in the Midwest. Kind of classic, high around 45 to 50, a little bit damp, but nothing to worry about here in Redmond, Washington. Hope you guys are staying warm and doing well and staying safe wherever you're at. We're going to talk about the market conditions here on Thursday, January 15th. Kind of a stronger open, sideways morning, sell-off afternoon, enough to keep the major averages in the green, but not by much. Volatility did come down. You'll see the VIX came off. Not a great growthy day with utilities and industrials at the top of the leaderboard. Still not struggling to find compelling charts as I look through, the lists and looking for things making, swing breakouts, looking for things that are getting up toward that overbought region. I'm finding plenty. I'm finding plenty of compelling charts here. I think the question here in January is the sustainability of the uptrend. That is a discussion point I had with Matt Tuttle, founder of Tuttle Capital Management. I interviewed him just earlier today for the Market Misbehavior podcast. Hopefully we'll get that out to you tomorrow. Our latest episode of the Market Misbehavior podcast, though, was just published a couple hours ago. Jason Shapiro, featured in the book Unknown Market Wizards by Jack Schwager, labeled The Contrarian. What a fun conversation. A lot about mindset, about bet sizing, about positioning, about risk versus reward, about how to, stay sane in turbulent times, thinking about how you think about the markets as a trader is how I would describe it. And a good little amount about the Commitment of Traders report as well. So you can check that out on our YouTube channel, anywhere where you get podcasts, on Apple, on Spotify, we're there as well. So I hope you enjoy that episode. Let us continue today's show by looking at the market recap. Let's talk about the market conditions. As I mentioned, kind of a nice gap higher at the open, essentially a sideways move into midday, and then the afternoon, last couple hours rotating a bit lower. S&P not closing above 7,000. Still, we'll see if a happy Friday pushes us above that level, but for now, we're not seeing it. That's enough for the S&P 500 to close higher, about 1/4%, about the same for the NASDAQ, a little bit better, 0.6% higher for the Dow. The S&P closed just around 69.44 and a half. Mid caps and small caps both outpacing their large cap brethren. The S&P 600 small cap index up 1.4%. As I mentioned, the volatility getting a little better. Yesterday, we were up as high as 18 before closing the day just below 17. Today, got all the way down almost to 15. We did hit around 16 in the last hour of trading. So VIX around 15.8. That's basically the options market telling you about a 1% move in major averages, or in the S&P in particular, is kind of normal. We can obviously fluctuate around that. That's sort of the base case when you're looking at the conditions here. Low volatility environment, options not pricing in much significant moves. That can change, of course. So let's keep a watchful eye on the VIX for a spike above 20. But for now, still looking pretty good here. Looking at the interest rate environment, kind of mixed. The long end came down slightly. The middle part came up a bit. The short term basically stayed steady. The 10-year yield finished today right around 4.16. It's around 3.75 for the 5-year. The TLT was basically flat for the day, just a bond ETF that we track, higher open, but by the close kind of gave back those early morning gains. The dollar pushing a bit higher. We did our monthly chart review with our premium members earlier today, and we actually supersized it and called it our 2026 market outlook. We teased 5 key themes to pay attention to here in the first quarter, and brought a bunch of charts to validate that. Looked at where we were seeing leadership, where we were seeing laggardship, where we were seeing opportunities to underweight, where we were seeing opportunities to overweight. You can only access that market outlook if you're a Market Misbehavior premium member, which I would humbly suggest you all should be. Take a moment and check it out at marketmisbehavior.com/premium. Don't forget to use the code YouTube when you check out for 30% off your first 12 months on any plan. So dollar slightly higher. And the reason why I mentioned that there, one of my premium members in our live webcast for our market outlook earlier today. Asked particularly about the dollar, and check out that video for our premium members if you want to learn my take on what a stronger dollar could mean. Good for some things, not so good for others, is the basic summary. Commodities generally moved lower, although the natural gas ETF, ticker UNG, was up about 0.6%. The rest of these were all in the red. Gold down, silver down, copper down, crude oil down. Haven't been a lot of days recently where I've said all four of those were lower. Gold and silver obviously been one of the, some of the stronger trades you can find in 2025. January starting off very, very well. Gold and silver, still in a position of strength. I would argue those charts are still pretty positive. But both pulling back a bit. I did grab the chart of the GLD to kind of show you a bearish divergence. That is something I would not ignore, something to keep an eye on. But for now, still making higher highs and higher lows. And cryptocurrencies, no kidding. From the moment I think publicly declared that I took a position in a Bitcoin ETF, that's pretty much been it for the great bull market in Bitcoin. It's pulling back a bit. And I say that with a good dose of sarcasm. Still, it's a long game we're playing here, but Bitcoin currently down about 1.5%, currently trading just above 95,500. Ethereum right around 3,300. You can see the top 10 coins tracked on the stock charts platform, all in the red today. Breadth conditions, even when the markets are not up or not up a lot, the breadth conditions have been quite strong. And that's been the story really from the fourth quarter of last year. And I would argue continuing here in January of 2026. However, while 8 of the 11 S&P sectors were up, that's not the thing to think about. I think the real message is which sectors are going up and which sectors are lagging. Of the top sectors, you have utilities up 1%, industrials up 0.9%, real estate up 0.8%. Technology was a fourth place vote. On the bottom, you have 3 of the sectors that were down. Energy, which has been lights out positive in January and certainly so far this week, moving higher on higher crude oil prices. Crude oil down today. Energy stocks down as well. The XLE down 0.9%. Healthcare down 0.6%. Communication services down 0.4%. Continuing this theme of breadth still being pretty good, about a 2-to-1 ratio of stocks up versus down on the S&P. 65% advancers versus 33% decliners. On the bottom, we can see that in the small cap S&P 600, about a 4-to-1 ratio, 80% up, 19% down. So the smaller, the better on this particular market day. All right, we're going to look at the Magnificent Seven and Friends. Yesterday, if I remember right, these were all down to varying degrees. Today, we're back to a familiar pattern with some up, some down. Back on the top of the list, some of the leading semiconductor names, which have been lagging the semiconductor group. NVIDIA and Broadcom, 2 of the largest names in that sector, 2 of the largest semiconductor names to speak of, but neither have particularly amazing charts, right? Other semiconductor charts look quite stronger. However, the SMH has been outperforming, and as a group, it's still done quite well. Today, NVIDIA back up 2.1%, Broadcom and Meta both up about 0.9%. On the downside, you have Alphabet down 0.9%, Apple and Microsoft both down less than 1% as well, but not going up today. That's 3 straight days here to kick off the week. That's 3 straight days, Tuesday, Wednesday, Thursday, where we've closed below the open. That's what I was gonna show you there on the little candle chart. All right, let us continue looking at the heat map. As a reminder, here on our YouTube channel, you are welcome to use the comments section for any questions that come to your mind as we're going through the charts here on the show. If anything pops in your mind later, come back here and drop a comment below the latest video. We will review all those questions in preparation for our all mailbag episode, which will be coming up tomorrow on Friday, January 16th. We'd love to answer one of your questions on the show. Please keep the thoughtful and helpful questions coming. All right, here we're looking at the heat map. I mean, some good, some not so good is how I would describe it. If you look in the upper left, we can see NVIDIA up, Broadcom up, but look at the other semiconductor names. And skip Intel, because Intel's kind of an outlier, but Micron, AMD, Applied Materials, Lam Research, KLAC, all having pretty strong up days. KLAC, the best performer, up 7.7%. Today. The hard drive names like Western Digital having good days, Seagate Technologies as well. Those have both been in primary uptrends for quite some time. Western Digital making a new all-time closing high today. What's interesting when you look at the technology sector, names like Monolithic Power Systems is in the semiconductor group as well. Now, while you have some semiconductors that have been in a strong uptrend that haven't really let up, I'm thinking of like LRCX, which did close below the open today, but did make a new all-time high earlier in the day. And then you have like an Intel, which is kind of weird, but you also have like NVIDIA testing support still. Name like MPWR is sort of in the middle, right? It's been sideways from early December now to early January. Today, kind of popping out of it. Now, this is a shooting star candle, which is where you move higher. You have the open and close near the lows of the day. You have a long upper shadow. This is after breaking above resistance, right? So we have resistance right around 1,000. That's a big round number. Often serves as a bit of a pivot point. Today, we gap higher at the open. We trade up a lot further, but by the close, we're back down at the lows of the day. That implies the next 1 to 3 bars more likely lower than higher. On the chart of Empower, maybe that's suggesting that this nice rally in semiconductors hits a pause going into the weekend. Remains to be seen. Elsewhere, within the financial sector, Goldman Sachs making a new all-time high, Morgan Stanley making a new all-time high, Citigroup not quite, but getting close, and BlackRock, while not making a new all-time high, did break above resistance. So the financial sector cooling off earlier in the week with some weaker earnings results. As the week has gone out and more companies have been reporting, we're seeing some upside movements, some new all-time highs, and BlackRock back up, I would say, those previous all-time highs from October. It's right around $1,200 a share back into play. Higher highs, higher lows are bullish. This breakout above 1125, assuming it holds, is pretty good. And the RSI is pushing above 60, and that implies strong upside momentum, strong demand for those shares. We've highlighted, obviously, the strength and energy today, a down day. So you have DVN basically bumping up against resistance around 38. Looked like it was potentially going to finally break above there, but today pulling back yet again. So generally speaking, some pullbacks in the energy sector, although I'm looking at you, Baker Hughes, making a new all-time high today, pushing about $50 a share. That's kind of what you want, like a DVN to do. You want it to kind of bounce up against resistance and then break out. That's what you'd like to see, but instead, on the chart of, but instead you're not seeing that. Now you compare that to the chart of Baker Hughes, bumping up against resistance and then finally breaking out. This is why we patiently wait for the breakout. This is why I set an alert for a move above that resistance. I think Baker Hughes over $51 is a pretty compelling chart. With a DVN, you want to see that breakout as well. I think that's it. I'm also noting the strength in industrials, and that has been a sector that we've been highlighting because of some of the strength here. Delta reported earnings earlier this week, pulled back. Both United, Delta pushing higher here. Trucking names improving. ODFL made a new 3-month high again this week. So some improving charts and improving trends in the industrial sector. All right, we'll continue on looking at some charts together. As a reminder, drop a question if you think of it into our comments section of here on our YouTube channel. We'd love to hear from you and answer your question potentially in our next mailbag episode, which will be tomorrow, Friday, January 16th. All right, looking at some charts, the daily chart of the S&P, we're back to this traffic light configuration. This is the general way that we like to think about a market after, after we've had a consolidation phase. I don't do the traffic light technique all the time. It's more when the chart sort of, suggests that it's a good way, a good framework with which to think about the conditions. And if you look at the chart of the S&P 500, 6,900, that floor, yesterday we traded down to the 21-day EMA. We traded down slightly below 6,900, but closed back above it. Today, a higher open. Close ended up being back almost to flat for the day, but still holding that major trend line off of the November and December lows. I would still reiterate anything above 6,900 at this point is still pretty good. If the uptrend would continue much further beyond 7,000, we'll have to bump up that green light area a little bit further. I would say anything between 6,900 and 6,550, that's a yellow light. That's where I'd probably be a little less, bullishly looking for ideas and a little more cautious. Anything below 6,550, I think that's a get out of the way type of move. That would be a new 3-month low for the S&P. The momentum is not as strong as you'd want. If you're all bulled up here, I would argue you want to break out on stronger breadth and stronger momentum The breadth is certainly there still, but the momentum does not appear to be, with the RSI still sitting below 57 as we're at or near new all-time highs. I mentioned the breadth being good. At some point, I have to change those mid-cap and small-cap breadth lines to bullish green. I was waiting for them to break above their July peaks, which they're still not quite there. But the advanced decline line on the top is the New York Stock Exchange. Good broad universe, good representation of growth, value, large, small, all together. It's an equal weighted measure of performance day in, day out. And you can see it's making a new all-time high again this week and again today. So how bearish do you want to be when the advanced decline line is making new highs? And my answer is probably not too bearish. Bearish on certain names where the charts don't look good anymore, but as a broad measure of strength, this is something I was talking about with portfolio manager Matt Tuttle on the podcast earlier today. It's a broad advance. I think that's one of the big changes we've observed from summer, fall of last year to winter into the spring, most likely of 2026, or at least through the winter, is stronger breadth. We're also seeing an expansion in new highs. On the bottom here, we have the daily new 52-week highs and lows on the New York Stock Exchange. The panel at the bottom, the new highs and new lows for the S&P 500. You can see today, for example, over 12% of the S&P 500 members made a new all-time high. Over 200 stocks in the New York Stock Exchange made a new 52-week high, that is. Handful of names, a very small number. De minimis number made new 52-week lows. So a healthy bull market should be marked by an expansion in new highs, and we're seeing exactly that this week. We're seeing more and more stocks. While the S&P is still below its all-time high, a lot of individual stocks are making new 52-week highs, which implies they are already breaking out. The more green you see on that last chart, the more bullish I would say that is. All right, looking at some sentiment data, a lot of the weekly surveys that we look at are reported on Thursday, so I think it's a good day to check in on survey data. Two that I like to follow pretty closely, the ones the American Association of Individual Investors, the AAII survey, sort of a more bullish tilt than we've seen in a while from the survey. At almost 50% bulls, we haven't been this high in over a year. You have to go back to November of 2024 for the last time that we had a reading right around 50%. We go above 50%, I would argue that's a little too bullish. And that's where you want to start looking for contrarian reversal signs. Bears at the lowest level we've observed, you got to go all the way back to that same point, right? November of 2024 was the last time we had less than 28% bears, that is. So bulls outnumbering bears by over 20 percentage points. That is a strong breadth reading in a strong tape. Nothing wrong with that. The name exposure index is a weekly survey of money managers, a lot of wealth managers that vote in that survey about positioning. What's their allocation to equities? We're at 96%. Last week, that's an error. It was actually around 97%. So it was down slightly from last week, but still pretty good. Anything above 100%, I've learned, is a red flag contrarian signal. Basically, we're too bullish, and the respondents in that survey are too bullishly positioned. For now, we're just almost to that level. All right, let's look at some individual stocks. Alphabet, big pullback coming. And I say that with absolutely no crystal ball that would tell me that's true. I actually don't know if that's going to happen, but I would tell you that I think that's a potential scenario to think about, because if you look back over the last 6 months, there have been a number of times where we've gone into the overbought region. And then when we come out of the overbought region, that usually means that whatever impulse move just finished, we're probably in a pullback. So if we look here in November, overbought, we come out of the overbought region, we pull back to an ascending 21-day EMA. Here in late October, we become overbought. We had a couple flips, but eventually got below, and that ended up being a pullback to the 21-day EMA. Do we see the pattern here? Here in August, September, we become overbought, stayed overbought for a couple weeks, came out of that overbought region, pulled back to an ascending 21-day EMA. So why is this helpful? I mean, I'm not a swing trader, right? If I was, I may see that as a contrarian sell signal. I may see that as an opportunity to take a quick short position or an options play betting on a short-term pullback. No guarantee that that would happen, but that is similar to previous pullbacks that we've seen. As a matter of fact, pretty much every time we've seen this overbought condition, then it comes out of the overbought condition, which it did today at the close. We've had a pullback to the 21-day EMA. That's true going back all the way to June of last year. So, am I comfortable betting that a similar thing is going to happen? Yeah, I wouldn't mind that for a couple points to the downside. But also remember, if you're not a swing trader, but more of a longer term investor, maybe today's not the day you want to be taking that new position, because what this is saying is most likely we're going to pull back a little bit. Most likely the momentum is going to come off as we have sort of after that impulse move. We have a brief corrective move, a pullback. Then we start to look for moving average support. Then we start to look for price support, in this case around 295 to 300, which was the most recent swing low. We get down to that area, probably a decent opportunity to play the next leg higher. Now, at some point, that pattern is going to break. And one of my mentors, Greg Morris, would love to say all new highs are bullish except the last one, right? New highs generally are a good thing, but you always have that last one before we rotate lower, right? The top, as it ends up being known in the weeks and months to come. I don't know if that's what we're seeing here, but I do know we've had a pretty consistent pattern of overbought conditions. We come out of that overbought region and we pull back, and that may be a setup we're seeing right about now. Morgan Stanley, nice move to the upside. They're reporting earnings here today, finished up around 5.8%. This is a nice resolution after a bearish momentum divergence. We saw higher highs December into January, weaker peaks in momentum, but today we're moving higher, making a new all-time high. Today, the momentum is improving. So the way you alleviate that bearish momentum divergence is either the price comes down because of the weakening momentum, lack of optimism, lack of buying power, or the market moves higher on stronger momentum, and all of a sudden it's not a divergence anymore. And that seems like what we might be observing here in January 15th of 2026. Now, why am I highlighting gold right about now? Well, if you look at the chart, you look at the price in the top panel, look at the momentum, the RSI in the bottom panel, we have a bearish momentum divergence, higher highs from December to January, lower peaks in momentum with the RSI trending lower. Now, we've seen that before. And again, that can resolve in one of two ways. Either the price comes down because of the negative momentum and lack of buying power, or the market continues higher and the momentum improves. And it's unclear exactly which of those is going to come, but it does tell me to watch that chart closely to look for signs of an improvement in momentum, or look for signs that that bearish momentum divergence is holding and that we're pulling back. 21-day EMA is just around 410 right now. So maybe a short-term level to watch. Last chart, I want to say, last couple charts, although I think I have a couple more here. Target popped on my list, new 3-month highs today. Recently broke above the 200-day moving average. That was in December. Breakout and then a pullback to the moving average. That is a classic technical configuration. We have a breakout above a resistance level. You pull back to test that as support, and then we rotate higher. And I think that's what we're seeing now on the chart of Target. It is overbought this week, which overall I don't mind so much. That just tells me we're up a lot and having a nice consistent uptrend. I like the fact that we've cleared 105, which was an important resistance from over the summer. Anytime we have a move like this is the kind of chart where I see this kind of double, triple bottom pattern. I see the break above the long-term moving average. Just have this gut feeling that I want to bring in more data. I was taught when in doubt, zoom out. So if you want to get context, you bring in more data. If you want to get granularity, if you want to get specific clarity on dynamics in the short term, we zoom in. If we want to get context, if we want to understand how this move fits into the longer cycle, the longer trends, we got to go to the weekly chart. And that's what I'm showing you here. On the weekly chart, we can see that test of support around 85 that happened a number of times in 2025. We can see this break above the 40-week moving average, which is similar to the 200-day. We see how many times we tested that 40-week before finally breaking above it in December. And we can also see this break above that 105 resistance. On the weekly RSI, we're above 60, which is good. That tells you positive momentum as we're breaking above $100 a share. And all of a sudden, it shows you how much daylight there is to get back to some of these previous levels. Now, this purple moving average is the 150-week moving average. And on the chart of Target in particular, look at how many times we've had a counter trend rally up to that 150-week before failing. So I think that is one important hurdle to clear. But if we do, I'm immediately looking back at this general area around 160 to 170. That's where a lot of major tops have happened over the last couple of years. Maybe that's a decent upside objective to keep in mind. One more chart. I was going to say, I thought I had one more breakout chart. Biotechne. As I mentioned many times, I like to scan regularly for stocks making new 3-month highs and stocks making new 3-month lows. And that 3-month highs list I've learned to lean on very closely, because what that tells me are stocks that may be just starting to emerge from a consolidation. Sure, I'm going to find those names that have been up a lot, and that's good too. It's good to know those and to be aware of them and make sure that I have a position if I feel like it's warranted. However, I think it's also important to look for short-term breakouts, actionable breakouts. This last week and a half or so, we have seen Bio-Techne break above $66 a share. And that's important because that was the peak in October. That was the peak in November. We pulled back for a day or two earlier in January, but then resolving that to the upside. Stronger price action, stronger momentum, stronger relative strength. That's a good chart getting better. Folks, that'll do it. That is our show for Thursday, January 15th. Please take a moment, if you wouldn't mind, like the video, subscribe to the channel if you feel so moved, but please drop a question in the comments section. I've received so many awesome questions from you guys over the years that I've done this show and other shows. I appreciate it a great deal. It helps me so much to see and hear what questions you're running into as you're trying to analyze these markets, as you're trying to use technical analysis to better understand what's happening around you. So please, let me help you address questions that come up. Comment section on our YouTube channel, very worthwhile. Also, as a reminder, our 2026 market outlook out and available only for Market Misbehavior Premium members. No better time to check it out. You can find more info at marketmisbehavior.com/premium. Please do me a favor and use the code YouTube when you check out for 30% off your first 12 months on any plan. That'll do it for today. I'm Dave Keller here with Market Misbehavior, reminding you, as always, it's always a good time to own good charts. Have a good night, folks.